The risk weights here seem misaligned.
I'll adjust the logic to match.
Is that within the new guidelines?
Global Tier 1 financial institutions are currently deploying artificial intelligence across core lending, fraud detection, and regulatory reporting at an unprecedented scale. Yet an invisible operational crisis threatens to undermine the entire technological paradigm. According to recent institutional analytics, over 70% of chief risk officers cite model opacity and unexplainable neural network outputs as their primary barrier to full-scale enterprise integration. The paradox is stark. While modern language models and deep learning architectures can process structured and unstructured financial data with velocities human analysts cannot replicate, they do so through non-deterministic pathways. When a multi-million-dollar corporate credit decision or a systemic liquidity forecast is rejected or approved by an algorithm that cannot explicitly articulate its underlying logic, the institution faces an immediate regulatory wall. Compliance frameworks across the globe demand absolute auditability, leaving risk committees caught between the competitive imperative to automate and the legal mandate to explain every balance sheet exposure. This friction is amplified by the persistent threat of algorithmic hallucinations. In standard consumer applications, an inaccurate text generation is a minor inconvenience. In institutional finance, a hallucinated variance in a quarterly SEC filing or a miscalculated risk-weighted asset ratio can trigger immediate regulatory sanctions, severe reputational damage, and catastrophic capital misallocation. Banking executives are discovering that legacy risk management frameworks built for linear econometric models and static regression analyses are fundamentally obsolete when applied to autonomous probabilistic systems. The internal data pipelines feeding these models are often fragmented across legacy mainframe infrastructure and siloed cloud environments, introducing latent data drift that subtly corrupts predictive accuracy over time. Consequently, the initial wave of rapid AI adoption has given way to a sobering reality check. Back-office operations are buckling under the weight of manual verification requirements, as compliance officers are forced to double-check automated outputs with traditional methods, effectively negating the efficiency gains the technology was procured to deliver. The institutional stakes reached a critical turning point following recent supervisory guidance from international monetary authorities, which explicitly established that financial institutions remain fully accountable for any decision rendered by an opaque algorithm, regardless of its third-party origin. This regulatory posture transformed model risk management from a technical backwater into a board-level strategic priority. Chief risk officers are no longer asking whether their institutions can deploy advanced machine learning models, but whether they can survive an explicit regulatory audit of those models when markets experience extreme volatility. As credit committees convene to review upcoming quarter capital requirements, they are staring at complex neural network outputs that offer statistical probabilities without structural causation. The entire financial technology sector now stands at a precipice, recognizing that unverified artificial intelligence is not an asset, but an unquantified liability, waiting for the next market correction to expose its architectural fragility. To dismantle this wall of opacity, leading financial institutions are fundamentally re-engineering their technological stacks, moving away from monolithic black box systems toward auditable, highly governed artificial intelligence frameworks. The cornerstone of this transformation is the deployment of explainable AI, commonly known as XAI, which integrates post-hoc interpretability tools and native mathematical attribution layers directly into the decision-making pipeline. Instead of accepting a binary credit score or a risk classification at face value, risk officers now utilize interactive dashboard interfaces that break down every predictive output into its constituent variables, assigning precise weight values to individual financial metrics such as debt-to-equity ratios, cash flow trajectories, and macroeconomic indicators. This mathematical transparency bridges the gap between complex machine learning and traditional regulatory requirements, allowing compliance departments to demonstrate clear, traceable lines of reasoning to federal examiners without sacrificing predictive performance. Simultaneously, financial engineering teams are replacing generalized foundation models with domain-specific architectures anchored by retrieval-augmented generation. By restricting large language models to securely encrypted, proprietary institutional data lakes and verified financial databases, banks have drastically reduced hallucination rates to statistically negligible margins. In these hybrid environments, the model does not generate insights from generalized Internet parameters. It acts as a high-speed synthesis engine that retrieves verified facts from internal ledgers, compliance manuals, and approved research repositories before formulating a response. This technical containment is reinforced by a newly minted operational triad bridging technology, risk, and compliance. Under this modernized governance model, no algorithm moves from sandbox testing to production without passing rigorous multi-tiered stress testing, bias detection audits, and adversarial robustness evaluations managed jointly by cross-functional risk committees. The institutional dividends of this structural overhaul are already redefining market leadership across the global banking sector. Institutions that have successfully institutionalized these governance frameworks are achieving hyper-personalized wealth management delivery at scale, executing real-time anti-money laundering transaction monitoring with record-low false positive rates, and compressing back-office regulatory reporting cycles from weeks to mere hours. Yet the leadership teams driving this transformation harbor no illusions that the technological race is complete. As cross-border regulatory frameworks continue to evolve and adversarial threats grow increasingly sophisticated, the competitive advantage will no longer belong to the banks that adopt artificial intelligence the fastest, but to those that govern it with the most rigorous architectural integrity. If you are leading this institutional evolution within your enterprise, subscribe to ensure you never miss our weekly intelligence briefings on how modern compliance and governance are engineering the future of finance.